And thanks so much for joining me today on the Careers and Finance podcast. It's been great to know you over the last, I think, 4 or 5 years. And on Careers and Finance, I bring on really interesting guests who have great stories to share about how they've built their career, what their journey has looked like. And then we dig into kind of what's happening in the industry and what's happening in the world as they see it. So, mate, welcome, and would love you to share with us some of your background and career journey.
Great. Thank you, Daniel, for having me. So, well, let's start from the point I got into the financial services industry. So, I think it's like any other good story, opportunity meets good fortune. I was working in tech at the time, working in a sort of client-facing role in tech at the time. And a friend of mine who was working for Citi Group at the time introduced me to their boss. And look, this is Citi Group just after the 2008 financial crisis. We're talking late 2009,
Oh, wow.
2010. Most people were running away from a career in finance. Now you can say I'm probably a glutton for punishment, that I just thought, well, why not? And I went and met this individual, and they offered me an opportunity to start in the private wealth team pretty much as a graduate. Soon after that conversation. And it was an incredible experience because Citigroup, being a large global conglomerate, actually invests a huge amount of time and money and effort in the people that they hire. So for someone like me, pretty green coming into this space, it allowed me to learn from a variety of people and really hone my skills around markets, investing, things of that nature. So yeah, that's kind of where the journey started. And I was advised for a period of time and then moved into funds distribution, I would say about 7 years ago. And most recently, I've become part of ETFShares as a chief revenue officer. This is a brand new business that launched its first products on CBOE.
Yeah, very exciting.
Yeah, so look, it's been a very interesting month, let's say that.
Nice, mate. Glutton for punishment, and now you're in it for the long haul, launching out to start ETF shares. What have kind of been some of your big milestones or really good experiences along the way?
Oh, look, man, it's too hard to even put top 3 out there. I think this particular step, which is becoming a part of ETF shares, would rank very highly in that journey. And the reason I say that is our executive chairman, Graham Tuckwell, was essentially the first person who brought ETFs to Australia back in 2003. So that's what,
Oh, wow.
22 years ago, almost now.
Yeah.
He started the gold ETF back in 2003, which then went on to have another gold product in the UK, in the US. And now he is sort of a mentor, a coach to all of us and a guide to our business. And that's extraordinary. This is a guy who's
Yeah, wow.
pretty much achieved everything that, people of my generation aspire to achieve. He's done that. And the ability to be able to just pick up the phone and speak to him, that's extraordinary. So I think this is a pretty
Yeah,
big
wow.
milestone for me. And look, working at Citi
Yeah.
was great. And watching the acquisition of ETF Securities by Global X and going from a relatively small Aussie business in terms of the number of people we had to a relatively large global business becoming a part of something like that, that was quite an interesting experience as well. Yeah, that's my top 3.
And there you go. And when you say your chairman brought ETFs and it's the gold ETF, do you literally mean ASX code gold?
That's exactly right.
That's him.
That's it. Yes.
Oh, wow.
And that ETF, Daniel, is so old that it wasn't effectively an ETF. It is an ETP, which is an exchange traded product. Because back when they started it, the concept of ETFs just did not exist in Australia.
Yeah, of course.
They had to create quite a unique structure to be able to bring that to Australian investors. And I mean, that product is still going. It's worth, last I checked, over $5 billion under management in Australia. And it's excuse the lazy pun, it is the gold standard even today. So he did something right there, that's for sure.
Well, I was going to say, the reason I was asking is because I'm like, I've actually bought and sold that ETF over time.
Yeah.
So it never occurred to me, I sound stupid saying this, but it's never occurred to me that someone actually created that ETF like 22 years ago.
Yeah.
Obviously, someone did, but it just never occurred to me that actually had a founder who made ETFs. There you go, crazy.
Yeah, it's quite a unique story, to be honest, because he was working on the commodities side of things with ANZ at the time, and he had this brilliant idea. But again, even ANZ had no idea how to make this into a reality. So he just went out and did it anyways.
There you go. Oh, it's good to be, when you're starting a business, it's good to be in the company of people who have done it, right? Who've gone out there, who have set sail into the other side of corporate world and found their way. So,
Absolutely.
Fantastic for you guys.
Yeah, look, it's great. We are very well aware of the size of the task that we have taken on. This is truly a David and Goliath kind of story, right? The other players in this space, BlackRock, Vanguard, their balance sheets are larger than certain small countries. And here we are, a sort of a four-man operation looking to take them on. I guess why we think we have a unique value proposition is if you look at a majority of the players in the passive ETF space, they are large global businesses with an Australian shortcut. What that means is they start out with products that work in the US market or in the European market and try and sort of retrofit that in the Australian market. Sometimes that works. A lot of times it just doesn't. Whereas we are an Australian-owned, Australian-operated business with focus on the needs of Australian investors and advisors. I've been an advisor slash broker myself. The rest of my team has worked very closely with Australian advisors. So we understand what are the concerns and objectives for them that we need to address. And I think that really is our point of difference, is to be able to create products that solve a problem rather than start with an idea and see if we can fit that into the Australian market. And then being quite a lean structure, we can also do this at a very attractive price point. And that's another thing that we bring to the market, because in the passive world, every basis point matters. And even if we can save the end consumer a few basis points, that in turn puts pressure on the rest of the players in this market to match us, to compete with us, which creates better outcomes for the end consumer, which is really what we're all about. This is why I suppose all asset managers do what we do, is to provide cost-effective and attractive solutions to the end consumer.
Yeah, that's awesome. And so then in terms of your first product you've gone out and launched, tell me what that is and what that niche is operating in. Like, how is that really targeting the market?
Yeah, that's a great question, Daniel. And let me go back a few steps before I answer this question for you. So, as I said, I've been a broker slash advisor in a previous life. And when I was working at one of the previous shops, we did a few information evenings for large stockbroking businesses in Melbourne, in Adelaide, in Perth. And we were blown away by the number of high net worth and some ultra high net worth individuals who had no exposure outside Australia. So their portfolio would be top 20, maybe top 30 Aussie equities, few hybrids, bit of cash, and that's that. So with our first tranche of products, the thinking was, if we kept this type of investor in mind, who has this incredible home bias, how can we facilitate a bit of diversification in their portfolio and give them a few options to do that? And we thought the best place to start with would be the largest stock market in the world, which is the United States. And what we did with our first tranche of products is create 3 different opportunities to be able to access the US market. So the first one is the top 10 stocks on the NASDAQ. They're called FANG, they're called MAG 7. Now they're being called Batman, which, make of that what you will. Yeah, and who knows what the next acronym is going to look like, but Batman is definitely interesting to say the least. So this is the top 10 stocks in the NASDAQ 100, equally weighted. If you don't want to do anything else, just want to have a bit of exposure to the US, this is not a bad place to start. The other one is WWW, which is, if you look at our market in Australia, it's so heavily concentrated in banking and resources, and we have very little tech exposure. So if you look at tech exposure, why not look at the largest tech market in the world, US? Here is a pure ETF, 100 stocks, all technology companies, nice and simple. It's in Aussie dollars. You can buy it in the Aussie market trading time. Again, a very simple way to do it. Or if you're someone who wants to take a more long-term view and invest in the US market, we've got a quality ETF which gives the investor access to a 100-company portfolio, which has very strong return on invested capital and free cash flow metrics. So that's if you're taking a more long-term view. And the whole idea is for those people who want to invest in the US but not really sure how, here are 3 options that you can pick from. That was kind of the thinking behind starting these first 3.
Yeah. I think it's interesting, watching that surge of technology, particularly off the back of COVID, and how much technological adoption that forced, and then seeing the businesses, and now for the rise of AI, obviously, and how that's pumping NVIDIA. And you kind of look to the Australian market and it's sort of like, well, the best tech company we seem to have is still private. It's not even public yet.
Yeah.
So most people can't get good access to the Aussie tech businesses that are going on, obviously Canva being the flagship there. But even there's many others. There's a lot more kind of happening in Australia in the tech space than people realise, but so little access for average investors at this stage. So going to America seems like such an obvious solution to that.
Yeah, and Canva is a great example, Daniel, that you brought up, because even they have indicated that when they do list, they will list on the NASDAQ. So they won't list on the ASX, they would list on the NASDAQ, which is not uncommon. And that's purely because the US has this incredible universe that they have created where you've got access to capital through investment banks and equity firms. You've got the network effects where you've got this massive tech industry already there. And then in terms of talent, you've got your pick when it comes to global talent that all flocks to the US, to the Silicon Valley. So if you're a tech business, it just is a very compelling art to list in the US. And it's not just Aussie companies, right? Like if you look at Chinese companies like Tencent or Alibaba, they have also chosen to list on the NASDAQ. And again, for those reasons that we've discussed, and that's where the whole idea of US exceptionalism has become such an important word in investing, especially since COVID, as you mentioned.
Yeah, so then access to the NASDAQ is starting to become access to the best kind of tech companies from around the world. Yeah. That's what's starting to happen.
Very much so. And that's what when we were, and I know we've been chatting about products a fair bit, but that's what we were thinking when we looked at the NASDAQ index. If you strip out all the non-tech names from the NASDAQ index, the performance is even stronger. And that's what led to the ideation of WWW, which is, if people are buying NASDAQ for US tech exposure, why not give them pure play US tech exposure? Why muddy that with things like biotech or financial services or communications? If you want tech, go buy the full-fledged tech ETF.
Yeah, wow. And that's even news today. I thought NASDAQ was pretty much just fully fledged tech.
This is the thing, right? This is what happens because what it says on the tin, the stuff inside isn't always necessarily the same thing. And that's very true with NASDAQ.
Yeah, there you go. All right, so we've dived in pretty deep straight off the front, which is great, but let me zoom out for a minute. ETFs, you mentioned kind of the first one being gold, came to Australia 20 odd years ago. In the last probably decade, I feel like ETFs have exploded in Australia
Yeah.
and are everywhere in Australia. What has been happening and why have ETFs come to to the front so quickly and so significantly?
It's a great question, Daniel, and probably the most pertinent question in terms of the investment landscape at the moment. I would put it down to three factors. Number one is simplicity, right? If you think about someone who is an individual investor, they've got a ComSec or a CMC account, they've got a bunch of shares. In order to buy an ETF, they can do that with their trading account. You don't have to set up an investment platform. You don't have to fill out a bunch of forms with a fund manager. It's ease of access of having it on the market. The next is certainty. So if I take you back to around the GFC, and I know you were an advisor as well in a past life, I'm sure you remember all the cash locked funds back in those days. People had money in a number of funds that got cash locked, and then you got money out, you got cents in the dollar.
Yeah.
Most comforting thing with ETFs is, whether that's active or passive, there's a market maker that sits in the background. So if you put a sell order through your trading platform, your order will get executed. Even if there is no liquidity in the market, the market maker will step in and create that liquidity for you. So as an investor, you know 100% that when you need to buy, you can buy, and when you need to sell, there's always a market for it. That certainty is invaluable.
Yeah, wow.
And then the last thing is variety. So with ETFs, you can buy something very vanilla. So you've got something like IVV, which is BlackRock's S&P 500 ETF, VAS, which is run by Vanguard, which is ASX 300, all the way from that real vanilla to Bitcoin in an ETF and everything else in there. If you went out of the Aussie market and you wanted to say get 3 times leverage on Tesla, you can. You want 3 times leverage in the opposite direction, you can also do that, right? So you can get really weird and wonderful with ETFs if you wanted to. So it's a really broad church, if you were to use that analogy, where from very basic investment demand to the most niche and esoteric, everybody can be catered for. And that's the third reason why ETFs have grown as much. And that's why a lot of the active managers are now putting out ETFs of their funds as well. So giving the investor dual access. Because for individual investors, for people like you and I, ETFs are just so much easier to live with, to transact on, than it is to do with a listed managed fund.
Yeah.
So I hope that gives you a bit of color around the rise of ETFs.
Yeah. Well, I was laughing when you started talking about Notion, slightly sketchy things, and you mentioned Bitcoin, and I was like, that's how I hold Bitcoin, simply because banks in Australia have clamped down so hard that you can't just buy Bitcoin very simply anymore, but you can still buy the Bitcoin ETF. There's no clamp on that.
Absolutely.
And so that's my little sneaky workaround as to how I get access to some crypto things.
I think you and I are in the same boat when it comes to that. So my exposure to both Bitcoin and Ethereum is through ETFs. I just can't, I'm not technologically savvy enough to set up a wallet and all the other. Look, I know these words, but I don't really know what they mean. So I stick with stuff that I know.
Yeah. And there's also a fair few of those crypto platforms that went kaboom a few years back. Thank you to those many companies that went kaboom. The ETF is much more straightforward than getting caught on an exchange that you thought was doing the right things and is not. So awesome. Look, it's a fascinating topic, right? How much ETFs have grown and grown. And it seems like there's a new weird and wonderful ETF that I see pop up every few weeks.
Yeah.
And just people finding, different investment thesis and fairly quickly able to create that ETF. But what are you seeing in terms of kind of high net worth individuals at the moment? Some of the ones you'd be talking to, some of the advisors you'd be talking to about their clients. Where are they sort of looking to allocate funds? And are you seeing a lot of uptake in ETFs from them, or is it more of a mass market retail kind of product?
It's an interesting question, and I think the answer would be a bit of both. Where we see from those high net worth clients or advisors who run books of high net worth clients, and I'm going to speak about public markets because that's the space that we operate in.
Yep.
US equity, global equity, that's probably sort of a perennial theme. People want exposure to that more and more. And what we're starting to see is that with more sophisticated advisors and investors, the home bias is definitely shifting. So go back 10 years ago, people were very happy to collect their dividends and franking credits, and that's that. But now it's very clear that in the Aussie market, you strip away all the value and you pay the dividends to the shareholders. Whereas if you get that capital, you could potentially invest in more growth projects. That sort of focus on US markets, global markets, that's something that's continuous. Beyond that, when we saw the rates in the US and globally go up sharply, we did see a significant move into duration on the fixed interest side. But that is starting to normalize a fair bit with the rates coming down in the US and more sort of global developed markets. And on the sort of direct investor side, I think ETFs is something that's just become more and more popular because you just can't get exposure to a lot of themes in the direct market that you can do with ETFs. And also just quite simply from a diversification point of view. Let's say you're a student, you're someone straight out of university, got your first job, you've got, I don't know, $5,000 to invest. You can buy yourself maybe 10 stocks. Whereas if you bought the S&P 500 ETF, you can get exposure to 500. If you bought our quality ETF Best, you can get exposure to 100 high quality, financially healthy stocks. So what you can get for smaller amounts of money in terms of diversification is just unmatched with any other sort of investment vehicle. So what we find is retail investors go more so for what's the label and what the returns are. Whereas with high net worth individuals and their advisors, it's more so trying to ensure that they have more balanced exposures in their portfolio and don't have this massive just home bias that we've talked about.
And one of the things you're kind of touching on there that does take me back to my advisor days, it was actually the amount of overlap you would find in portfolios. You know, where someone is buying a managed fund and it'll, you know, say it was an industrial share fund or something like that. It would have some interesting title, and then they'd have the Australian share fund, and then they would have some sort of other resources fund or something like that. And it's like, you realise that company are in all three. You've just bought them 3 different times. You know, and you realise you've done, you know, all these different things. And when we would unpick kind of what's actually in their portfolio, the diversification they thought they had by picking multiple funds just wasn't there. And I've noticed a lot of that in the ETF space, where what you're seeing is a lot of these very kind of, I don't know if niche is, there's definitely niche funds, but funds that are maybe a bit clearer and more transparent within subsets of the market that allow you to really clearly kind of go, no, I am diversified because this tech fund is all Aussie tech, this tech fund is all US tech, this tech fund is global tech only, you know, and it kind of is much easier to break these things apart and pop the hood and see what's underneath.
Very much so. Very much so. And I think that's the sort of work, Daniel, we do for our clients, advisor clients all the time, where they'll give us their portfolio of ETFs and we can compare and talk about what are the crossovers, what are, you know, duplicate exposures across different funds. And that's another great thing of passive investing, why it's become so popular, is just that complete transparency. If you go on our website or any other passive ETF provider and you pick any ETF, you can find out what stocks or what bonds or what securities that ETF invests in to the last dollar. Can't do that with an active manager because that's their intellectual property. So yes, you know what the top 5 or the top 10 holdings are, but beyond that, you're just guessing. And I think with the advent of the amount of knowledge that is available out in the world on the internet through investment forums and blogs and all this sort of stuff, the idea of being kept in the dark is something that people are just not comfortable with anymore. And that's where we see this huge rise in passive investing because it gives the end user a sense of confidence that you just can't get an active manager in.
Yeah. And I'll never forget, I had a client who was just entering into retirement. And when he entered into retirement, it was not long after that I finished up as an advisor and handed the client over. And one of the questions we asked in the handover was there anything you wish Dan had done differently? And his answer came down to this: when I'm invested in these various funds, I don't know what's in them and I'm trusting Dan. And the results have been good.
Yeah.
But when I see on the 6 o'clock news, Aussie market bloodbath, it makes me stress. And I wish you had just sent me a message to say, the strategy's okay, the portfolio's okay, ignore the news. And I was like, oh, how interesting that just seeing the bloodbath in the news made him stress because he couldn't actually see what was sitting in the portfolio. He didn't understand how he was invested. And I mean, he was a retiree. He had about a 30% exposure to that.
Yeah.
So there was just so much that he didn't understand beyond the label on the tin of what he was invested in.
Absolutely. Yeah, and it's such an interesting point you raised, Daniel. This whole idea, and this is something that retail investors unfortunately struggle with, is how do you shut out the news sometimes? And people often react to things based on what's happening in the short term. To give you an example, earlier this year, all the stuff that was happening in the US with Trump and tariffs and, this idea that we were talking about that this is the end of US exceptionalism and sell US was the trade to be in and all of that sort of stuff. And here we are, less than 6 months later, markets are again on the up and up. Does that mean everything is resolved? Most certainly not. The war in Ukraine is still raging. Could very easily start putting tariffs on another country tomorrow and ramp that up. And that could again put the markets in a state of turmoil. So this idea that you just get caught up in the news is quite an interesting one. I'll share an anecdote with you. There was a research done by broking platform in the US as to who were their best performing investors. And they went through their entire client list. And the 2 categories of people who performed the best in this particular trading platform was, 1, the people who had lost their password and hadn't accessed their account in a number of years. And the next one, as grim as this is, were people who had passed away and their accounts hadn't been touched.
No.
These were the top 2 best performing categories, right? So that just goes to show you that sometimes the best thing you can do is to do absolutely nothing.
Yeah.
So,
yeah,
I found that quite funny as well.
That's shocking. It makes total sense, though. It makes total sense. I could share a bunch more stories of clients who made shocking decisions that cost them enormous amounts. But look, the thing I actually want to focus on just for the last kind of 2 minutes of our chat here, you guys have launched out a really exciting business, ETFShares, into a crowded marketplace. You've articulated why and all those things earlier, which was awesome. But you've also done it in this, what I would say has been a highly volatile time for the markets. I'd love to just hear how that's been for you personally. You've clearly got such clear conviction, to go and do this, and this is going to work, and you guys are going to be able to build this and give it a red hot go. But it's one thing to do that when markets are going up and everything's rosy. It's another thing to do that when Trump's throwing tariffs left, right, and center, and the world is very confused, and markets are tanking you know, and then surging off the back end when he pauses all the tariffs, and you've got all this kind of volatility. I would love you just to share for kind of 2 minutes on that journey and even holding to your convictions when the market is all topsy-turvy.
A really good question, Daniel, and quite a big question. So let's take this apart in two pieces, right? Why did we launch now when the markets are so topsy-turvy? Markets are going to do what they're going to do. It's well and good to be a student of the market, to understand macroeconomics, to understand financial news as well as economic performance. But to say that because there is turmoil in the market, I'm just going to step out and not partake altogether, that's just a terrible strategy. And you and I, through our sort of career as advisors, have experienced this with people who have stayed on the sidelines. More often than not, have ended up way behind those who stayed invested through the period of turmoil. So we're bringing our ideology as investors into this business, which is, quite simply, it's time in the market rather than timing the market that matters. The second thing around why sort of do this, especially at a time when Trump is, doing all the things that he is doing. I suppose that's our secret sauce. One thing that we were very successful at back in the ETF securities days as well is we were very good at dealing with private wealth managers and stockbrokers, providing them with intel, insights, guidance, tools to be able to navigate through difficult times in the market. So in this current climate, when there is so much going on, I think we're quite well placed to be able to add actual tangible value to the advisors and brokers who we aim to work with. So in terms of that, we think this is actually a great time for a business like ours to come up. And we feel that this is a time where we can really separate ourselves from the crowd. So we think this is a great opportunity for us. And it's understandable that there might be ups and downs in the market, but I think we're quite well placed to inform and educate our clientele through those ebbs and flows.
Yeah, awesome, mate. I love it. Love the courage and to seize the day, to see that as the opportunity rather than the obstacle. I think that's going to serve you guys so well as you grow this business, and I can't wait to see the success that comes from this venture, mate.
I appreciate it. It's been great to catch up and do this in a sort of a formal format. I mean, you and I have many conversations sort of on a regular basis about all sorts of things. It's nice to do this in a formal setting as well.
That's it, mate. Love it. Love your work. And thank you so much for being my guest today on the podcast. And look forward to see all that comes.
Very good. Great to be here. Thanks, Daniel.